This will not be a video about making a lot of money. If that made you click away, good. This will be a video about how to protect your wealth. I will reveal to you what the so-called, by me, insurance assets are, why they are important, and why they can literally save your life. I mean, your actual life, not your investments. But first, let's broaden out a bit. I have a big issue with how financial advisors and gurus define risk. When you hear them talk about it, it is always related to losing 50% of your stock portfolio, or volatility in the stock market, or mixing bonds with stocks so that you don't have big losses during recessions, and on and on and on and on. And I'm like, do you people even understand what the full meaning of risk is? So let's dive into the topic. The financial industry's definition of risk often is extremely limited because it only looks at risks within the financial markets. It makes sense because that's where these people spend their whole day, but it's very narrow. An example of a risk within the financial market is you having a stock that goes to zero, or losing 30% of your portfolio because of a market downturn, and other examples like that. Now, you certainly need to know about these things, and we will discuss them later in the videos from the series. But first, I want to explain to you that risk is not confined to a stock going to zero or your portfolio losing 30%. You know what else risk is? War. Having to flee your country. Confiscation of private property. Totalitarian governments. Hyperinflation. And other cheerful events like these. Now, depending on where you're watching this from, some of these might sound a bit far-fetched, but to some of you, these risks might be very real. To the latter crowd, you already understand the importance of what I'm talking about. To the former crowd, don't think you're beyond the reach of these events. Of course, if you live in the middle of USA, you might not be as concerned about a foreign invasion or hyperinflation, but that only means that you might want to allocate some more percentage of your portfolio to these insurance assets, not eliminate them entirely. Okay, so what assets am I talking about? There are two main types in this category. The first one is precious metals, and the second, cryptocurrency, mainly Bitcoin. These are the type of assets I will talk about next. Now, before we go into the details of each one and why you want to own it, let me explain to you why I have chosen to teach you about these two types of assets and call them insurance assets. At first glance, there is little in common between precious metals and cryptocurrency. One asset type is a physical object, and the other is digital. One is probably the oldest asset type that exists with thousands of years of history, and the other is the newest with roughly 15. One is associated with older folks who are extremely financially conservative, and the other with younger millennials and Gen Z. One is the ultimate place where you store your wealth, and the other is the ultimate gambling vehicle. With so many differences, you might be thinking to yourself, why is that guy putting them in one bucket? Is he insane? Well, if you ask my family members, they might tell you I am, but that's a topic not related to the current video. While I understand the vast differences I just pointed out, when it comes to protecting yourself from extreme and adverse events, these two asset types have a lot in common. The main thing is that they are both what's called bearer assets. Bearer, not bear. A bearer asset is an asset that doesn't require a third party to be present when a transaction occurs. There are only three types of assets like that: cash, precious metals, and cryptocurrencies. The common thing between them is that you can transact with another person without the need of a third party. For example, if you want to buy food with your Visa credit card, Visa can stop or spy on the transaction. If you want to transfer money to an individual that your bank doesn't want you to transfer money to, they can easily stop the wire. If you want to sell or transfer your shares in Apple, your brokerage where you hold the shares, or even the stock exchange, can ban you from doing it. And even with something tangible and physical like real estate, you can't transfer property rights unless a centralized property register acknowledges the transaction. I mean, you can kind of trick someone into giving you money for your house, but unless they're a complete fool, they will want some documents and a third party like a notary service confirming their ownership. However, if you want to buy food in the store, you can pay with cash and no one can stop you or even know you did it. If you meet someone in the middle of the forest and give them gold coin in exchange for a forbidden secret book, no one can stop you. Same goes for sending Bitcoin to anyone in the world. So that's the most important characteristic of the bearer assets. The second thing in common between cash, precious metals, and cryptocurrencies is what is known as self-custody. In simple terms, self-custody means you don't rely on any third-party service for access to your assets. To illustrate the point again, let's go through the main other asset types. If you have money in the bank, you need the bank's permission to have access to it. If you have stocks, the brokerages is holding them on your behalf. This is not necessarily a bad thing, I'm just describing facts. If you have real estate, you need the acknowledgement of the state in some form of register in order to own it. Otherwise, you would have to patrol your properties with a gun to make sure they are still yours, which is obviously ridiculous. Cash, precious metals like gold or silver, and cryptocurrencies are the only three assets you can store by yourself without the permission or knowledge of anyone else. Unless you are physically forced to give them up, they cannot be confiscated with the stroke of a pen of a bureaucrat. Okay, so we have bearer assets and self-custody in common between cash, precious metals, and crypto. The third thing I will talk about is where physical cash drops out from what I call insurance assets, and the reason I am not including it. And that is control by a centralized body. You see, even though you can hold cash in your pocket, its value is still controlled by a centralized body called the central bank. Yes, you can move it freely without the approval of a third party, but its value is not subject to only the market forces. Your cash can literally become worthless overnight with a decision made by a few people in a building situated at the other side of the country. This is impossible with gold or Bitcoin, for example. Now, if you're watching this from the USA or Canada or Europe or any of the more advanced stable nations, then this might be less of a concern. But anyone watching me from a country like Egypt, Turkey, Argentina, Nigeria, and others are painfully aware of what I'm talking about. Some of these people have lost all the value of their savings with the stroke of a pen of a politician. And even if you live in the USA or Europe or Australia, well, over the past century, even the strongest currencies like the Swiss franc and US dollar lost over 95% of their value. Whereas if you had an ounce of gold a century ago, you could buy a top-notch outfit and you can still buy one today. Also, we are not only talking about inflation and hyperinflation. Governments can literally decree that certain type of euro or dollar bill is not accepted anymore, and all of that cash under your mattress become worthless. So, why the term insurance assets? Because in my opinion, while you can make money trading these, their main goal is not to make you rich. Their main goal is to protect you. And yeah, I know, you can buy Bitcoin for 10K and sell it for 50K, but that's more on the trading side and not what I want to focus on. Those types of assets are insurance assets because they protect you from extreme unforeseen events and allow you to have complete control over them. Unlike the productive assets, which I described in the previous video and we'll talk about later in the series, which generate economic value and so can pay you for owning them, a gold coin buried in your backyard does nothing. A Bitcoin sitting on the blockchain does nothing. They don't produce anything. This is the main reason why I would never advise anyone to make them the majority part of their portfolio. However, depending on where you live and what your personal situation and beliefs about the world are, I think it's healthy to have those types of assets as a minority part of a diversified portfolio. Now, as I said, these assets won't make you live noticeably better. They don't produce anything, they won't pay your bill or allow you to retire. However, what they do is insure you, hence the name, against black swan events. For those of you who don't know, black swan event is something extraordinary that no one can foresee happening, like COVID, 9/11, war, a government making a decision in the middle of the night, etc. Your stock portfolio falling with 20% is not extraordinary, and I'm not talking about these kinds of events. An invasion or a civil war starting in your country or an overnight currency hyperinflation is what these assets are made to insure you against. So, now that you have the overall picture and knowledge, in the next part I will focus on the two types of assets in this category: precious metals and cryptocurrencies, starting with precious metals. So click on the video on your screen right now to go to the next part in our series, and I'll see you there.